Hi guys, hope everyone is looking forward to the weekend. I wanted to get this one out there a little bit earlier than normal. I think what I want to do this week is really just walk you through some charts that I think are obviously super important at the moment. Obviously, the landscape of the market has changed in the last 3 days. I think that's going to be evident with some of the charts that I'm going to be walking you through today. But I think it's also important that I walk you through history as well, recent history. Those of you that are maybe new to my work, maybe those of you that are new to the group, etc., you won't know this, but over the last few years, I've been able to communicate effectively about getting defensive ahead of time before we see these big market drops. Now, that's obviously helped to save many accounts, and I think the data that we're seeing historically, I think, has application to today as well. So, let me just walk through the charts. If anything doesn't make sense to anybody, feel free to reach out to me privately. But I think it's very important that I present the data as is, and you guys can obviously arrive at your own logical conclusions. Obviously, the message over the last few weeks has definitely been, cautiously bullish. I think it's just downright cautious now. So yeah, manage risk closely. Start protecting that capital because what we've seen historically, obviously, we'll go back to January 2018 where we had obviously this correction here. One of the characteristics that made this correction pretty easy to kind of not predict, but say that we're going to get a drop pretty soon was an extreme overbought market. RSI was massively high. Now this is the Dow Jones. You can apply this to the S&P 500 as well because the S&P 500 is obviously, huge correlation with the Dow. So we've seen the same thing with the S&P 500. Extreme overbought market. It's logical that we get a drop, and that's exactly what we've seen. Okay. Now, when we fast forward to the correction in October 2018, the characteristic of this one was we had pretty clear divergence with RSI momentum coupled with a failed breakout. Now, you've probably heard me say many times with failed breakouts, we get fast moves in the opposite direction. And again, that's exactly what we've seen here. Now, I've highlighted this extreme volatility box. Now, I don't know if any of you remember, or maybe you just weren't part of the technical side of things, or didn't know the technical side of the things back then. But when we had this extreme volatility, and we're talking, 500,000 point swings in a day, that is what was going on here. We don't want to be participating in the market at this point. And when we got this correction, we chopped about sideways. But when we start to break key support levels, that's when I was advocating shorting the market. Okay. Now, when we fast forward, obviously, to today, yes, we've seen some drops here and there. But what are we seeing here? With the Dow, we're looking at a potential failed breakout here, and we've got divergence. So that's obviously happened in the last few days. We've obviously dropped below this key level. So this is the early warning signal to just say, let's tighten up stops, let's protect the capital, let's protect profits, let's not take any chances. Yes, the market might rebound massively Monday, Tuesday. Yes, we might get a Trump tweet on Sunday night saying, the market's great, deal with China, coronavirus has been eradicated. Anything could happen. But what the technicals tell us is just to get defensive. And that's the message I kind of want to, put over to you guys this week. I think there's a time to be aggressive. There's always a time to be defensive. Obviously, I've highlighted this the last couple of weeks, the divergence. We also need to understand as well that when the market breaks key support levels and we have these failed breakouts, again, you might have heard me say that there's always an index that gets the party started. I think that index might be the Dow. What you'll find is if the Dow and the S&P 500 break key support levels, the rest of the market is likely to follow. And for me, the S&P 500, I think this is the level to be conscious of. Now, let me just switch over to the weekly chart. Now, again, when we get these big drops, the market will find support somewhere. I mean, we just need to look again to, previous history. I mean, this is a logical buy back the market. The weekly 200 MA, we got a clear bounce and you can buy the market again. So if we do see these big drops, the market's going to find support somewhere. I don't see that we're going to enter a complete market meltdown, bear market or anything, but it stands to reason that we just need to get defensive because we don't know what is going to happen. So that's really what I'm seeing with the Dow and the S&P 500. Again, we've got triple Q. I think be aware of the danger zones, because I think if the Dow and S&P 500 drop, like I said a second ago, the tech sector, which I've got a couple of charts to follow up on the triple Q in a second, but I think this is a level that we absolutely need to be aware of. I think if the triple Qs drop below this level, I think that's a concern. We've obviously got the Russell 2000. Again, be aware of the danger zones. What you also have to bear in mind is with the Russell, when the Russell and the small caps entered their corrective phase, they dropped 27%. Now, that's obviously massive. So I would be very, very cautious here. I think if the Russell breaks below that level, I think the small caps, you're probably going to say goodnight to a lot of them. So again, that's another chart. I actually think that you can actually get a really good read on the market just from those four major indices. Tell us most about what's going on. We can dive a little deeper. We can see the XLC, which is a tech sector. Potential failed breakout here. We've got divergence. Again, XLK. I think this is the level where we're very, very close to breaking below that. I think given the XLC, given the Dow, etc., again, if tech starts to roll over, that is not going to be great news. So we need to start looking at other areas of the market, and that's going to be the theme of today's analysis. I'm not going to be presenting you guys with 52-week highs. I'm not going to be presenting you with stocks that are showing strength, because at the end of the day, if stocks are declining, we don't want to be participating. We need to be looking at other areas. And I know from the chats this week, obviously when we start to get the declines on Wednesday, Thursday, Friday, I know there was a chart that was sent out for GDXJ, which I'm going to touch on in a second. A couple of the gold names which have obviously advanced massively the last couple of days. Again, if you're not in the group chat, guys, if you're not in the charting chat, I would highly encourage you to get added to it, because I'm able to communicate in real time with absolutely everybody, and it'll make a lot of sense once you're in there why you should be in there. So again, XLK, it's not a time to be a hero. It's not a time to be buying these dips, in my opinion. I think there's a potential big issue brewing. To the other side of that, when one area of the market declines, other areas start to move. Now, we've obviously had a breakout recently in TLT. Now, for me, what you're going to see, I've actually started to use price alerts within Optima now instead of with my broker. So these green lines, if you ever see them, it just means that I've got a price alert set for this level. And for me, TLT above 150 makes a lot of sense. I think it would be a breakout, would start to advance in a declining stock market. And I think you need to look to kind of the safety areas. Obviously, gold has broken out. It's obviously moving. Precious metals, again, it's a safe haven asset. It's where you can look for safety when we've got a declining market. We don't want to be shorting stocks at the moment. We don't want to be gambling on the declines. I know there's many of you out there that are going to be taking puts on the major indices, on the triple Qs I've seen this week. For me, it just makes more sense to just move into these defensive areas. So I think gold, again, makes a lot of sense. It looks like silver is close to breaking out as well. And we've obviously got a chart that I posted to social media this week. And I thrown out there just during the week that if there's anybody out there that's looking at buying European stocks, you might want to kind of look at this one. You can look at this particular ETF. You can have a look at the stocks aligned with that ETF. But again, I'm watching this one closely. Obviously, I'm European, so I've got no problems buying European areas of the market. I'm not always US based, Canada based like many of you. So I'm able to kind of look at other areas. I think if we get a breakout here in European financials, then that's going to be interesting for European banks, etc., European insurance companies, etc., etc. But I would encourage you to look at the stocks aligned with that particular ETF, or indeed look at that overall ETF and make a decision as whether it's something you want exposure to. Now, I've had a lot of messages about semiconductors, individual semiconductor stocks. Now, please bear in mind that it's not always about the individual stock. Yes, Nvidia's a great company. Yes, AMD's a good company. But it doesn't matter. If we're getting failed breakouts in semiconductor areas of the market, and this is obviously SMH, then that's a concern. Again, failed breakout, divergence. How deep is this pullback going to go? Who knows? But what it's really saying to us is when we get these failed breakouts in individual sectors, we need to start thinking about preserving profits. And again, the theme of this weekend's analysis is just protect the profits, get defensive. I could be absolutely incorrect, but I think I take the view that it's easier to take buy positions back in the market than it is to replace lost capital. So yeah, again, do with that information as you wish. You're all grown-ups, you all know how to manage your money, you all know how to manage risk. This is just a technical view of the market, and given what we're seeing there, I think it makes a lot of sense to start tightening up stop losses. So yeah, I was going to touch on the rotation graph this week. Let me just actually switch this to the weekly rotation. Now, there's a couple of things that obviously I'm picking up on here. Now, this is obviously long term. I know that there was somebody, I can't remember where it was, during the week posted the weekly rotation graph and showing the move into defensive areas which has been accumulating over the last few weeks. That's what we're seeing. So TLT, gold, XLU, utilities, there's obviously been a rotation. Now, this is why the weekly rotation can be sometimes a little bit misleading, because obviously we can see here the Sky ETF is moving into a leading area of the market. That's not the case, in my opinion, with the breakdown that we're seeing in obviously the tech sectors, ETFs. So I oftentimes like to just drill it down to the daily rotation just to kind of see what's actually happening just on a shorter term basis. I find that that's a more useful rotation graph, but that's just my personal preference. Again, we can see XLU, TLT, they're obviously starting to advance, but we can see obviously SMH is starting to decline, and Sky is actually on the decline as well. So we're definitely seeing a bit of a rotation into these defensive areas. So obviously I've just talked a lot about the overall market, what I'm seeing. The other thing to say is that over the last 2 days I've ripped through about 1,500 charts, and I'm seeing the same scenario play over and over. We're seeing declines. If I just actually switch back to the is it SPY or is it just yeah, we're seeing less stocks participating. Obviously, we're seeing declines in stocks that are trading above their 50 period simple moving average as well. So that's just showing us that there's weakness in the market, real weakness. So out there, just start getting defensive, guys. If you've not been defensive, I know many of you have already gone to cash. I think it makes starting to make a lot of sense. Yes, we're going to have stocks that are continuing to work. Trade updates, ENPH. Obviously, a huge congrats to everybody. I know most of you are in, but again, I don't see the point in leaving a stop loss way down here at 47. I think you need to start thinking about tightening up stops, preserving profits, etc. Just on the off chance that we do get further declines. Now, crowd, yep, a frustrating one. We've obviously had declines over the last couple of days. It does look like we've got a bit of support. I think what I would want to say here is if we do start to get a bit of a rally, just start moving your stop loss up with that rally. Again, I don't see the point. Obviously, well placed stop loss 58.50. That was obviously the alert. I don't see the point in waiting for that to get hit if the market's going to decline. So I think if we do get any rallies here, I think you just start moving up your stop loss and start protecting capital. Don't sit there and just wait for that stop loss to be hit given the overall market conditions at the moment. That would be the message with crowd. Again, PayPal, stop loss, I've got just under this level here. Again, we want to see a rally over the next Monday, Tuesday, maybe with a couple of stocks. If we get that, I think, again, just start moving the stop loss up with it would make a lot of sense. Again, don't just sit there and be passive and just wait for that stop loss to get hit, because if we do see the market declines, it's going to be a massively frustrating one. AbbVie, again, just be strategic, stop loss below here. I did actually notice that obviously biotechs did okay Thursday, Friday, which with AbbVie being a big component of the biotech area, you know, if we're going to see biotech become a defensive play, which would be really strange to me, but if we do see it, then again, just be strategic. I know some of you bought this breakout here. Again, if you've not de-risked your position already, just be strategic with your stop loss placement. Don't utilise the ATR trailing stop. Place it below lows. I think we've got a candle here. If you just let me zoom in. Yeah, we've got that date there on the 20th of February. So just place it below the 20th, the low on the 20th. But again, if we start to advance here, just start moving your stop loss up with it. It just seems to make a lot of sense to me. Massive congrats to everybody. I know there's a lot of you that have cashed in recently on health insurance innovations. Again, messages that this thing could still run even in a declining market. So just be strategic with your stop loss placement. Don't let it get too far away. Again, placing it below, you know, certain lows of the day there. Again, 20th of February. Don't sit there and be passive and wait for an ATR trailing stop to be hit. If you've not already got it below this Fibonacci level here, I think it makes a lot of sense to just, you know, start to kind of move the stop up strategically with price. Eventually you'll get stopped out, but you know, you're going to get stopped out with a big profit on that one. Right, getting a bit of a sore throat from talking so fast. Charts that I think you can look at for the short to medium term. Okay, the market's still in a structural uptrend, but if we're going to see a bit of a decline or a corrective phase, these are areas that I think you need to add to your watch list. So we've got GDXJ. Now this is obviously the chart that I obviously posted to the chart groups this week, was this one, how we were breaking out. Obviously we had a big advance on Thursday, Friday, but again, just build out the analysis. We've obviously got a breakout. We're hoping that this one starts to move towards 50. That would be a reevaluation point. That would be a compound point. You can obviously switch it over to the daily chart so you can see it clear as day. We've got a breakout followed by continuation. There's a bit of room to run with RSI. I think GDXJ needs to be added to your watch list. Now obviously this is one of the stocks that I posted on, because when we have gold moving, we can look to the gold ETFs, we can look to the individual gold names, the companies aligned with the ETFs, etc. For those of you that didn't pick up my watch list of gold companies, go back into the charting chat. I posted it on Friday, the S&P Utilities ETF, and also my personal gold watch list as well. So go in and hunt those down and add them to your own watch lists. But we've had a monster move recently. I don't think you need to go chasing this one. But if gold is going to continue to advance, I think any weakness in KGC can be bought. Yes, completely understand that this is not a stock that I would typically post on, given that it's trading at around 550, 590. But those are the stocks that people are going to buy. You're going to have everybody jumping on board these ones. Penny stock traders. So these are ones that are going to move. And that's why I posted it to the chart group the other day. And obviously this has had a 10% move in a couple of days. So absolutely, KGC, add it to your watch list. GDX is another gold miner ETF. I've got an alert set there for 31.20. I think if we get a breakout above resistance dating back to August 2016, that's not bearish. I would expect the gold miners to obviously move with it. Obviously, this is another stock, Barrick Gold. Again, we had a breakout here. Again, this is the other stock that I posted on. It was KGC and Barrick Gold that I commented during the weaker areas. We've obviously got a breakout. Looks like we've got a bit of continuation. For those of you that bought that, I know there's a few of you that did. Obviously, we have a reevaluation point, and then we've got a compound opportunity there, I think above 23.80. So that's a stock that if it's not on your watch list, you should probably add it. Again, utilities, traditional defensive area of the market. American Water Works is one of those that you would want to be participating in. Utilities have had a huge move recently. Rob, I know this is a favourite of yours. I'm sure you've bought in at multiple points already. But again, it looks like we've got a breakout. Looks like we're getting a bit of a retest. And again, if the market is going to decline, the broader market, again, you'd expect utilities to have things like breakouts, successful retests, etc. So that's one that I wanted to highlight to you as well. Finally, now I'm not advocating buying this, but given that absolutely everybody has asked me, commented about it, is this a traditional earnings discount? Yes, it is. It looks like we've got the support level in place there, which is a previous breakout area. But do I want to be buying it in the face of a declining market? Possibly not. But I've put this in here for you guys anyway. If you guys think the market is not going to drop, if you think ZS is a good risk to reward, proposition. If you like it, it looks like we may have found support. Will I personally be buying it? Probably not. And I think if you break this level here, you could probably short it and take puts. I think the question is, it's not whether or not ZS is a good company. I think earnings shown that it's decent. The real question is, does Wall Street want to own it? And that's the big question of the day. So what happens from here is absolutely down to Wall Street. Yes, it's an earnings discount, but overall market, do I want to be buying it or moving into defensive areas? I think defensive areas make a lot of sense to me personally. But guys, that's the weekend analysis for you. Hopefully this has all made sense. If nothing makes sense, if you're completely lost, feel free to communicate with me over the weekend. I'm going to be back to the laptop on Sunday evening as normal. For those of you that have yet to respond regarding the options, there's been a big uptake in it. We're going to be getting everybody access to the options program this weekend. We're going to be building in the options community, the forum, and Sean is going to be coming on board on the 1st of March. But I think it makes a lot of sense to just get everybody access to the content in the week before, just so that you guys can obviously just hit the ground running and have your questions ready for him, because I know he's actually quite excited to come in for the month. So yeah, if you are wanting to learn options, guys, this is a fantastic opportunity. But naturally, it's up to you. If you want to take advantage of that. But guys, enjoy your weekend, and I'll pick up with you all soon. Thanks again.